In this video, we're going to be going over the practice for the final exam, problem number 1. In problem number 1, the president of the retailer, Prime Products, has just approached the company's bank with a request for a $30,000 90-day loan. The purpose of the loan is to assist the company in acquiring inventories. Because the company has had some difficulty in paying off its loans in the past, the loan officer has asked for a cash budget to help determine whether the loan should be made. The following data are available for the months April through June, during which the loan will be used. On April 1st, the start of the loan period, the cash balance will be $24,000. Accounts receivable on April 1st will total $140,000, of which $120,000 will be collected during April, and $16,000 will be collected during May. The remainder will be uncollectible. Past experience shows that 30% of a month's sales are collected in the month of sale, 60% in the month following sale, and 8% in the second month following sale. The other 2% is bad debts that are never collected. Budgeted sales and expenses for the 3-month period follow. So we have sales, merchandise purchases, payroll, lease, advertising, equipment purchases, and depreciation. Merchandise purchases are paid in full during the month following purchase. Accounts payable for merchandise purchases during March, which will be paid in April, total $140,000. In preparing the cash budget, assume that the $30,000 loan will be made in April and repaid in June. Interest on the loan will total $1,200. So in the first requirement, we're supposed to calculate the expected cash collections for April, May, and June, and for the 3 months in total. And in requirement 2, we're supposed to prepare a cash budget for the 3-month period. So the first thing that I'm going to do is I'm going to calculate the cash collections. And once again, we're told to calculate the cash collections for April, May, and June. Now what we're going to have to account for is March sales, April sales, I'm going to skip 3 lines, May sales, here I'm going to skip 2 lines, and then June sales. So for March sales, we go to piece of information number 1. Accounts receivable on April 1st will total $140,000, and they're just telling us, so instead of March sales, that should have been beginning accounts receivable, because some of those sales were actually in March, and some of them were in February. So we're told in part 1, $120,000 will be collected during April, and $16,000 will be collected during May. So I'm just going to put the $120,000 in April, and I'm going to put the $16,000 in May. Now we're going to use part B. Past experience shows that 30% of a month's sales are collected in the month of sale, 60% in the month following sale, and 8% in the second month following sales. So for April sales, the amount that is going to be collected in April is 30%. 30% of a month's sales are collected in the month of sale. So collected in April, for me, my April sales are $300,000. So collected in April is $300,000 multiplied by 30%. I'll do all of the calculations in a moment. Now, April sales collected in May, we're told that 60% are collected in the month following sale. So my April sales of $300,000, 60% will be collected in the month following sale, which will be May, and then the remaining 8% will be collected in June. We don't have to worry about the amounts that are not collected because we only have to care about cash. If we were talking about accrual, revenues and expenses, then we would care about the amount not collected. So for April sales, the amount collected in April $300,000 at 30% or multiplied by 30%. The amount collected in May, $300,000 multiplied by 60%. And finally, the amount collected in June, $300,000 multiplied by 8%. Now I'm going to do the same thing for May, but May will be collected in May, June, and July. So I'm not going to have to worry about July because they've only asked us for the cash budget for April, May, and June. So for me, my May sales are $400,000, and of that amount, 30% will be collected in May, and 60% will be collected in June. So here, $400,000 multiplied by 30% will be collected in May, and $400,000 multiplied by 60% will be collected in June, and again, $400,000 multiplied by the 8% will be collected in July, but we're not asked to budget for July. So for May sales collected in May, $400,000 multiplied by 30%, and collected in June, $400,000 multiplied by 60%. And finally, now we're down to June. So June, we only care about June. June will be collected in June, July, and August, but we're not asked to budget for July and August. So my June sales are budgeted at $250,000. So 30% of that amount will be collected in June. So now all I have to do is sum up each column. So I'm just going to sum up the entire column, and Excel will ignore any blank cells. So now I have the total cash collections for the 3 months. So notice that even though April sales are $300,000, we're only going to budget to be collecting $210,000. Even though May sales are $400,000, we're going to collect $316,000, and June's budgeted sales on account $250,000. We're actually budgeted to collect $339,000, and the last thing that they asked for was it in total. So I'm going to add up all of those three numbers. Total cash collections, $865,000. So let's put this in. April, $210,000. May, $316,000. June, $339,000. And for the quarter, $865,000. So we've got all of those correct. Now we can move on to requirement 2. Requirement 2 is asking us to prepare a cash budget. Believe it or not, we have quite a bit of the cash budget already. So now the next thing that we're going to have to do is cash payments for the merchandise purchases. So we'll do that similar to the cash collections. Now, going down the other ones, we were not given any information about the other expenses, so we're just going to assume that they're paid as incurred, except for depreciation. Depreciation is the one expense that is never going to be paid, so we can actually ignore depreciation. So once we do the cash payments for merchandise purchases, we're pretty much ready to go into that cash budget. So what I'm going to do is do it here, so we can actually just copy the numbers instead of scrolling back. So the next one that I have is cash payments for purchases. So we're told merchandise purchases are paid in full during the month following purchase. Accounts payable for merchandise purchases during March, which will be paid in April, total $140,000. So I'm going to once again budget the cash payments for April, May, and June. So we're told that our beginning accounts payable of $140,000 extra information C will be paid in April. Now we're going to look at April's purchases. And we're told that April purchases will be paid in May. My April purchases are $210,000. That amount will be paid in May. Then we're going to look at May purchases. May purchases are going to be paid in June. Our May purchases are $160,000. And the June purchases will be paid in July. But once again, we're not budgeting for July. So now what's going to happen is, for each month, we're going to start off with the beginning cash balance. So, for me, we're told in extra information, Part A, that on April 1st, the start of the loan period, the cash balance will be $24,000. So starting in April, cash balance will be $24,000. The next thing that we're going to look at is the cash receipts from sales. Then we're going to look at the cash payments for purchases. Then we're going to have some other cash payments each month. So we're going to have cash for payroll. We're going to have cash paid for lease payments. We're going to have cash paid for advertising. And we're going to have cash paid for equipment purchases. But remember, we're not going to have cash paid for depreciation. So for our cash budget, we're just going to ignore that. So if we take the beginning cash balance, add the cash for sales, and subtract all of the other numbers, what we're going to get down to is our ending cash balance. Now the key to this is that the ending cash balance will be the beginning cash balance for the next month. So let's get started. In April, our budgeted cash received from sales is $210,000. And our budgeted cash paid for purchases $140,000. For April, the payroll is $20,000, given in the problem. The lease payments are $22,000. The advertising, $60,000, is going to be paid. No equipment purchases are budgeted in April. So we're going to have a tentative ending cash balance, but we're supposed to assume that the $30,000 loan will be made in April and repaid in June. So actually, instead of calculating the ending cash balance, we're going to have our loan, and we're told that the loan will be made in April, so we're going to receive $30,000 in April. Now we can calculate the ending cash balance, and it's just going to be, since I put in the cash payments as negative numbers, all I have to do is add up the column. So if I add $210,000 and $24,000, the beginning cash and the cash from sales, and subtract all of the other cash payments, I'm going to budget that I'm going to end up with $22,000. So in May, I will start off with $22,000. The next thing in May, we budgeted $316,000 cash from sales, and we budgeted $210,000 in May that we're going to pay for April's purchases. Now I go right down the list. May payroll is $20,000. Lease payments are $22,000. Advertising is $60,000. No equipment purchases, and no loan is budgeted for May. So we can add everything up, and our budgeted ending cash balance for May, $26,000. So in June, we'll start off with a beginning cash balance of $26,000. Our budgeted cash receipts in June, $339,000. We have our cash paid for purchases in June. For May purchases, $160,000. We have our payroll, which is only going to be $18,000 in June. I'm just copying the numbers from the June column, right there. $22,000 for the lease payments. $50,000 for advertising. And we have equipment purchases of $65,000. Now we have one more thing. We were told in Part D that we borrowed $30,000. We're going to repay $30,000 plus $1,200. So for the loan, we're going to repay $31,200 in June. Now I can add up everything in the June column, or I could have copied the formula over. And we can see that we're going to budget an ending cash balance for June, $18,800. Now let's put that into our budget. So April, we have a $24,000 beginning cash. We budgeted $210,000 collections from customers. Our cash disbursements are for purchases, $140,000. Payroll, $20,000, given in the problem. Lease payments, $22,000. Advertising, $60,000. That does not belong there, it belongs here. $60,000. And equipment purchases, $0. So it gave us our cash available, cash disbursements. So notice that we have $30,000 in borrowing. We have $0 in repayments and $0 in interest. So we're going to budget an ending cash balance of $22,000. I'm going to make this a little wider so we can see May and June. So we budget May. We're going to start off with $22,000. We budgeted $316,000 in cash collections, $210,000 in purchases, $20,000 in payroll, $22,000 in lease payments, $60,000 in advertising, $0 in equipment purchases, and in May there's $0 financing, so $0 borrowings, $0 repayments, and $0 interest. So we're going to end with $26,000. If we end with $26,000, we begin June with $26,000. Cash receipts, $339,000 from customers. Merchandise purchases, $160,000. Payroll down to $18,000. Lease payments, $22,000. Advertising, $50,000. And then we budgeted for that month $65,000 in equipment purchases. Now we move down to financing. There's $0 borrowings, but we are repaying $30,000 plus $1,200 in interest. I think that needs a negative number, negative $30,000, and negative $1,200 in interest. So we've got our $18,800 as our budgeted ending cash balance. Now let's check our work and see if we're correct. Everything is correct. Answer is not complete because I did not calculate the quarter. Now for the quarter, you have to be careful because the beginning cash balance for the quarter is not the sum of those three numbers. The beginning cash balance is the cash balance on April 1st, $24,000. Next, we have to put in the total cash collections from customers We already calculated that, $865,000. Now all we have to do is add up each one of these three numbers. So I'm going to take 140,000 plus 210,000 plus $160,000. When I add those three numbers together, I'm going to get 510,000. That's not 510, that's 210, 510. Now the next line, when I add 20, 20, and 18, I'm going to get 58,000. If I add 22 plus 22 plus 22, I get 66,000. If I add 60 plus 60 plus 50, I get $170,000. 0 plus 0 plus 65,000 is relatively easy, 65,000. And then finally, 30,000 borrowed, 30,000 repaid during the quarter, and $1,200 of interest paid during the quarter. And notice how that's 1,200, not 12,000, and a negative. So notice how the ending cash balance is not the three added together. The ending cash balance is at the end of the quarter. Now we're going to check our work. Notice now, answer is complete and correct.